we are back with our monthly market outlook for February 26. If we look at global economy, the government debt is expected to keep on rising. This will be driven mainly by the large fiscal deficit which countries are carrying. Despite that kind of debt burden, growth in 2026 will be lower than the last year, and it will be also lower than the historical average. Of course, India, along with Indonesia, China, Singapore, is towards the higher end of the growth. Central banks have been pursuing easy monetary policy in 2024 as well as 25. Their choices will become limited in 2026. Despite this kind of situation, investors continue to show high level of confidence in market, and their average cash level is on the lower side compared to historical average. One of the challenge for global economy is that unemployment has started rising in both global as well as emerging market. There are countries where the latest unemployment is higher than COVID times as well as historical averages. Courtesy higher unemployment, global consumption has started flattening out, or in emerging market started falling. Japanese 10-year bond is now at a multi-decade high. For years and decades, Japan was provider of yen carry trade liquidity to the world. Now, as the Japanese bond yield has started rising, chances are that carry trade will reverse and money will start going back to Japan. If that happens, there will be many asset classes where unwinding of yen carry trade could have material impact. Indian equity and bond market seems to be having very limited participation of yen carry trade, and hence impact on us should be bare minimal. This is BofA investment strategy, and they are now talking about how keywords are replacing investment trends across various sectors. If we come to Chinese economy, undoubtedly in electric vehicle, they have amazing achievement. In 2021, their EV sales were probably 1/10 of American passenger vehicle sales. Last year, their electric vehicle sales at about 1.5 crore vehicles was more than all the automobiles sold in America. What a phenomenal achievement by China. In terms of power capacity, China in last 4 years alone has added all the power capacity of America. And last year alone, China has added all the power capacity of India, which it has built. On a purchasing power parity basis, China is roughly little more than 2 times India's per capita per purchasing power parity GDP. Ideally, their power capacity should be double that of India. Today, it is almost 8 times higher. You can just imagine with what ferocity China is growing on electricity. Undoubtedly, capacity utilization across China has started falling as more and more capacities have come on stream and demand has not kept pace. As excess capacity starts hounding companies, their investment has started declining. As private investments has started becoming subdued, government of China is increasing fiscal stimulus. They are trying to push more money in the economy. Of course, China has to borrow to fund fiscal deficit, and their long bonds have started increasing from little above 10% of the total borrowing in 2019 to now as high as 30% of total debt. From our point of view, China's achievements have been truly amazing, but those growth has come without profitability. In last 20 years, Chinese markets have gone up 6 times and come down 6 times. We want history to repeat this year. Instead of going up, Chinese market should correct. If that happens, more flows will come to India. US economy grew at 4.3% in the third quarter, driven largely by domestic consumption, but also by AI investment. Company after company like Amazon, Microsoft, Google, Meta, Oracle are talking about investing substantial sums of money in hyperscalers. This is resulting into about 0.5% of additional GDP to the American economy. Undoubtedly, from COVID time, American GDP has accelerated and it is up about 58% in last 5 years. From $20 trillion, economy has jumped to almost $31 trillion in 5 years. However, the growth in the economy is accompanied by growth in the debt. In fact, debt intensity of economy is increasing. That is, US has to borrow more and more debt to produce same level of GDP. Unlike China, where majority of debt is long dated, in America, almost 25% of debt is maturing in next 12 months. That's a substantially large number or large amount to refinance. As Fed raised interest rates to support inflation control, America's debt burden as well as cost of servicing debt started rising. In the third quarter 2025, total service cost of debt between federal and state is likely to exceed $1.4 trillion. As America's debt to GDP ratio expanded, their cost of servicing debt as a percentage of GDP started moving up. Today, within G7 nation, compared to France and UK, America's cost of servicing debt as a percentage of GDP is higher. The other interesting data about US is frequent revision in the payrolls after they are officially released. Consistently, estimates have been higher and actual numbers have been lower last year. In fact, in about 11 months, US employment number has been revised downwards by about 6 lakh jobs. In US, income inequality is rising. The top 10% versus bottom 80% gap in spending is probably at decadal high level. Consequently, the dollar index has depreciated by almost 12% since Jan 25. Weak dollar should unnerve global investors, and their investment of about $30 trillion should show some exodus, some taking out. MSCI Emerging Market Index has outperformed MSCI Emerging Market Index since Jan 25. This is first year of outperformance after a long gap of more than 10 years. Weakening currency along with underperforming market should push global investors to take profit or capital out of America. Other interesting observation is America's market cap as a percentage of global market cap. It has started declining from about 58% to 47%. Coming to budget, it was a test match budget rather than T20 budget. It was continuing work of last 11 years, where first few budgets focused on infrastructure, then on manufacturing, and with this budget, services sector is being covered. If we look at the budget, there were good things and there were bad things. Levy increasing STT was uncalled for. STT was levied in lieu of capital gains. Capital gain made a comeback. Rate on capital gains increased. Now STT rate are increasing. Undoubtedly, government has failed to honor its promises to the taxpayers. SGB was again a wrong thing. On 31st Jan, people who bought SGB thought it was tax-free. On 1st February, that becomes taxable. The explanation that SGB were supposed to be tax-free only if you hold till maturity isn't convincing, because then SGB should have been non-transferable. But by giving transferability, you did give impression that SGBs will remain tax-free to the buyer. Small savings and government bond switch is more technical for debt market, so let's ignore. The good part of the budget was that capex at 12,10,000 crore was higher than the net market borrowing of 11,70,000 crore. The gap between capex and net market borrowing program was reducing, but it exceeded for the first time in your and my lifetime in this budget. This was possible because government pursued the path of fiscal prudence. The other interesting thing about the budget was 84 amendment made in the Income Tax Act, which was applicable from 1st April 2026. Government had published this act for consultation. When citizens, taxpayers, and chartered accountants gave feedback, government amended yet to be launched scheme, yet to be launched tax code by 84 amendments. सरकार के वहां पे सुनवाई है is proven by this. The Safe Harbor Act gives protection to Global Capability Center against whims and fences of income tax officers. The government had made a mistake of taxing buyback as dividend. They have now rectified that by separating promoter shareholders versus non-promoter shareholders. Promoter shareholders will pay little extra tax. Non-promoter shareholders buyback will be now considered as capital gains. This budget is also investing for future. It is investing in biosimilars, container manufacturing, electronic component, SME fund, and so on and so forth. Whether this budget is good or bad depends upon execution. SME fund should get disbursed this year, unlike RDI fund, which is waiting for disbursement for last 2 years. High-speed railway corridors and dedicated freight corridor between Surat and Dankuni should be built like Konkan Railway Corporation, not like bullet train. The REIT for PSC should be operational, unlike Custodian of Enemy Property Act, which for last 7 decades have not been able to monetize real estate. TRS market making and infrastructure guarantee fund is very good concepts for debt market development and infrastructure lending, but they should become operational in market acceptance, unlike interest rate futures and credit default swaps, which has not taken off. The relaxation of limit for PROI investment from 5% to 10% and 10% to 24% is a step in the right direction. But we all know as mutual fund distributor how difficult it is for NRI to invest. Virtual KYC don't exist. If you are US investors, we need you to present your passport showcasing when did you come and when did you go, so that we can prove that these transactions happen on Indian jurisdiction. The redemptions require so much of data and documents. Overall, if we don't simplify NRI rules and regulation, how will they invest in India? This budget has many good things, few bad things, but outcome will depend how we execute this matter. The good part about budget in FY17, about 14% of capex was on 14% of spending was on capex. That has now increased to 22%. Of every 100 rupees spent by government, 22 rupees goes towards creation of assets. That's a fantastic achievement. The quality of expenditure has improved steadily over the years from 13 to 22, as illustrated in this number. The path of fiscal prudence despite COVID setback is slowly and steadily achieved, with 4.3% deficit projection for next year. Coming to Indian economy, the broad headlines has been positive. Thanks to tariff, government took several steps to stimulate domestic economy. Money were put in the pocket of consumers, be it taxpayer, speculator, consumer, borrower, or recipient under Manrega scheme. All those constituents got some benefit from Government of India in last year's budget. There is eighth pay commission likely to be coming into play in 2027, but it will be effective 1st Jan 2026. Anywhere around 3 lakh crore per year will be compensation to 1.2 crore salaries, pensioners, and defense personnel. If all this money are spent on Apple iPhone, we will make America great again. If all this money is spent on Swadeshi goods and services, India will become great again. We are negotiating with EU and US and New Zealand and other countries for FTA. EU will be subject to ratification by European Union. US details and nitty-gritties have to work out. New Zealand, Australia, and other countries, our FTAs are already operational. We are also putting various other steps like FDI in insurance, Shanti for nuclear, labor laws liberalization, MSME, and ease of doing business. All these reforms, along with money put in the pockets of consumer, should result into economy doing well if spending happens on Swadeshi goods and services. While in absolute terms, central government capex is increasing as a percentage of GDP, it has started flattening out. The private capex to nominal GDP ratio has declined from 6.5% in FY11 to about 2.9% in this period, 2004 to 2014. A lot of these companies raised money from the debt market to fund their capex. Now, capex itself has slowed down, limiting debt supply into the market. While the private capex remains on subdued, at least announcements have started increasing for newer projects. Obviously, those announcements have to get converted into action on ground. One challenge, bank CD ratio is roughly about 81%. If a bank gets 100 rupee deposits, they have to provide for capital by about 8%. They have to maintain 3% CRR, 18% SLR. Imagine out of 100, 21 rupees goes to RBI and government. You are left only with 79 rupees to invest. No wonder average historical CD ratio is 75. We are already at 81%. Will banks have money to lend? Remains to be seen. The employment generation across India seems to be moving in comfortable range. Rural employment is increasing. Manrega demand is coming down. And rural wages are maintaining real bias. Along with employment, we also receive flows on remittance. We get almost double the flows of what Mexico receives. We are the world's largest recipient of remittances from various parts of the world. As employment and remittance both remain strong, consumption continued to remain strong in FY25 as well as likely to remain strong in FY26. The household sector is consolidating as their borrowing and leveraging has started coming down. Overall, FY27 growth could be somewhere around 7 to 7.5% range, depending upon whose projection you take into play. The connection between GST growth and economy has come to an end as a lot of cuts have been passed on in September 24. Undoubtedly, government must be hoping that new GST collection happens in a manner where instead of posting negative numbers, it becomes on the positive side. We export far less to China compared to what we import from them. Hopefully, we will be able to negotiate some greater access to import market of China. The INR continued to remain weak against dollar, albeit US trade deal did push rupee a little bit. RBI continues to run $60 to $70 billion short position, and that should have an adverse impact on rupee. The EU-India FTA is a win-win situation for both the interested parties. Hopefully, India will be able to export textiles, gem and jewelry, handicrafts, and aquaculture to European market. The EU tariffs are crashing in labor-intensive jobs. The Monday night declaration of broad contours of Indo-US trade deal is a step in the right direction compared to some of our peers like China at 30%. We have been proposed a tax rate of about 18%. This tax rate favors vis-a-vis some of the other peer group. The lesson of India-US trade deal is that time in the market makes money, not timing the market. We could not have known when US deal will happen, and hence, instead of waiting for it to happen, it might would have been better to invest in the market. The Tuesday morning bounce in Nifty was due to short covering as well as people jumping because of the fear of missing out. The sentiments have turned positive in rupee rates and equity market, but devil is in the details. Adversely impacted sectors like textiles, aquaculture, gem and jewelry, chemical should benefit as those tariffs may get normalized. Oil prices have started rising and now crossed $70 a barrel. That's a risky territory. Monsoon this year is likely to be impacted by El Nino. While final confirmation comes around May, omens are not good for this year's monsoon. AI is disrupting software industry all over the world. American software stocks have underperformed Nasdaq by the widest margin this century. Anthropic release of a product has pushed de-rating of IT companies all over the world. Will this impact large number of employees, more than 20 lakh people who are working in such large IT companies? With all the plus and minus, India today contributes about 1/12 of global economy on purchasing power parity basis. And on an incremental basis, we will contribute more than 15% in incremental global GDP growth. Converting this to market. India's market cap to GDP ratio remains high at 129%, but profit to GDP ratio is also in excess of 5%. Nifty index is almost near all-time high. So small and mid-cap continues to remain on the lower side. One interesting analysis for all 18 months from September 24 to Jan 26, Nifty 100 total return index is about -4%. Median stocks are down about -3%. The Kotak large cap fund, which is benchmarked against Nifty 100, in the same time is down about 1%, outperforming index. And the SIP return in this fund is about 6%. In Kotak mid cap, against -3 and -8%, Kotak mid cap fund has outperformed index by falling less. And also the SIP in mid cap fund has delivered about 3% return. Small cap fund obviously is underperforming benchmark index. This one fund has done quite badly in last 1 and 3 years. It is down 17% over benchmark index of 14%. And the SIP return also are not satisfactory at -10%, albeit much better than index return. Kotak multi-cap fund almost down as much. Kotak multi-cap fund on the way down has outperformed multi-cap index. Fund is down 3%, index is down 6%. But both have delivered positive return on SIP. It is only Kotak small cap which even on SIP basis have delivered negative return. For last 6 quarters since June 24, earnings have been disappointing, below expectation. December 25 quarter is no exception, as labor code and rupee depreciation has hurt profitability. We still believe Nifty index results which have come so far at 7% up YoY profit for Nifty 50 index should sustain in the days to come. This is the snapshot of Nifty 100 companies. The corporate capex is the weaker, subdued factor. Otherwise, household debt to equity ratio and government's fiscal deficit is counterbalancing each other. If we get a scenario where corporates starts leveraging and making investment, earnings growth can accelerate. After 2 continuous years of earnings growth decline, next 2 years should be positive from a growth point of view. FPIs have sold about $23 billion since 2024 across sector in CY25. They were buyers in telecom and energy, but sellers across other products like IT and hardware, FMCG, power, healthcare, realty, industrials, financials, autos, etc. Other countries have outperformed India. MSCI Korea is up 135%, India is up 1.6%. No price for guessing which way investors will shift their money. courtesy, dilution, and continuous selling. FPI holding in Indian equity market is now at 2012 level, 15.6%. India's share in global market cap peaked at about 4.6% in July 24. It has corrected now to 3.3%, around historical average of 2.8%. Earnings are set to recover amongst peer groups at about 15%. MSCI emerging markets have underperformed US since 2011. Now there is a reasonably good chance that MSCI emerging market will start outperforming American markets. FPIs like private equity and promoters will continue to sell in companies like LG, Hyundai, Whirlpool, or Grow. Active FPIs in secondary market may slow down their selling as their holding has come down to 15.6%. HFTs, courtesy SEBI's increased supervision, may be able to make less money. With STT increase, again, their ability to make money also gets reduced. The FPI who are buyers in primary market may continue to buy. Passive FPIs, as the flow comes in MSCI emerging market, should be net buyer in India. Overall, I will say that CY26, FY27 could be very different from beginning to end. On one side, FPIs are sellers. On other side, there are chances that FPIs may become buyer. As we speak, emerging market ETF got the highest flows in the month of January. If $20 billion comes into MSCI emerging market index, about 16% of that flows to Indian market. Domestic investors, thanks to you, has continued to buy equity. Thanks for all your support on SIP, which allows us to go and buy in equity market against all the challenges. Valuation wise, small cap looks expensive at about 23 times against historical average of 16.9. Large and mid caps are trading around their historical averages. Despite negative return between October 24 to Jan 26, SIP returns have been positive except in small cap index and small cap fund. This is what you will see on our website and monthly presentation on a regular basis. It shows that our equity stance is neutral, neither overweight nor underweight. And on both gold and silver, we continue to remain overweight, albeit with readiness for higher volatility. Residual amount is invested into debt, arbitrage, and margin money product. Kotak multi-cap fund is 44 large cap, 29 mid cap, and 26 small cap. In that fund, we have to put 25% each in small, mid, and large, and balance amount is discretionary. We think markets will be volatile because of all the geopolitical risks. About 290 stocks have delivered more than 100% return in last 6 years. About 175 stocks are trading above 50 PE. That is substantially higher than BSE index at Jan 20. The one message which we should carry to investors: please moderate your return expectation. Last 6 years return is about 15%. The mid and small cap return was driving this number with 22 and 18% return. But 15 years before, total market return was 11%, led by large and mid cap. Over 20-year period, broad market return is 12%. Outlier is mid cap and small cap on the extreme end. Overall, we believe if you are looking at 22% plus return, then that's unlikely to happen. This may be 2 years return rather than 1 year's return. Please moderate customer expectation in high single digit, low double digit as the expected return from equity. Equities remain neutral weight as our asset allocation indicated, and we remain overweight mid cap, neutral weight large cap, and marginal underweight small cap. Coming to equity invest opportunities, on a rolling return basis, most of our equity funds have outperformed benchmark indices. This is across other equity and hybrid schemes. This is point-to-point return on equity funds bearing small cap and mid cap. We have outperformed indices across major time periods. This is again for hybrid and other equity funds. Across most periods, we have continued to add value to our customers. This is SIP performance, where small cap and mid cap funds have underperformed benchmark indices, but other funds have delivered better return than the benchmark indices. Limited point active fund management is still adding value to the fund managers. Some of the funds which you can consider: Kotak Business Cycle Fund. This fund moves from one sector to another, and while moving, it doesn't have to book, it doesn't have to pay tax because of the mutual fund exemption. That tax compounding, tax deferment makes this fund attractive. Pioneer Fund has the option to invest money overseas. We have invested about 19% of money in global funds. This portfolio has delivered reasonably good performance. We are launching Services Fund, whose NFO opened on 4th of February. The field of Services Fund is very wide, from consumer services to financial services to IT to telecom to healthcare to entertainment. 3 trends drive services. First, rising per capita. Below $2,000 per capita, you invest in roti kapda. Above $2,000 per capita GDP, you invest in services. Second big trend supporting services is urbanization. There are more gyms, restaurants, theaters, in urban India than in rural India. Digitization also helps in services. Earlier, we were Swiggy or Zomato boys of our family or our neighborhood. Now, even a kid probably knows how to order on Swiggy and Zomato. This three trend of urbanization, rising income, and digitization is helping services growth. Services is the fastest growing and the largest component of Indian economy for years. The nature of services also change as we move from dining at restaurant to instant food delivery. These are some interesting tidbits about services in our presentation. If you haven't read it, do spend a minute to read this. In the services, the return on equity is generally higher than broad market as their profitability margin remains higher than the broad market. This is the sectoral bifurcation of services index and the top 10 stocks of Nifty services sector. On the passive investment side, we continue to expand our portfolio, whether it is market cap or broad-based, smart beta or commodity. Now we continue to remain one of the lowest expenses fund house and one of the lowest tracking error fund house in country. We also continue to manage sectoral stroke thematic funds and also fund of fund for overseas investment. This is our recommended portfolio of passive funds at today's point of time. Coming to fixed income market outlook, there are pressure on advanced economies to control inflation, keep rates higher. And you could see how 2019 level in green is way below 2025 level in pink. The mighty US was borrowing at 2.1%. Now it's borrowing at 4.1%, almost 200 basis points higher. Fed is expected to cut Fed future by 25 to 50 basis points in this year. US inflation has softened but continued to remain above 2% level, which is what Fed is looking from a psychological point of view. Rupee continues to show weakness, even though it has become undervalued against other currencies on real effective exchange rate. RBI revised down inflation forecast for FY26. It started at 4% and now it is ending the year at about 2.1%. The GDP growth for FY26 came at 7.4%. When we started the year, assumption was 6.5% or 6%. Very few people were talking about growth rate higher than 7%. While there are challenges, as RBI governor mentioned, we are in a Goldilocks situation. The net borrowing program of market at 11 lakh crore is slightly ahead of market expectation. This is mainly driven by short-term treasury bills borrowing going up by 1,30,000 crore. As I mentioned earlier, banks' CD ratio is running at a higher level. That is primarily driven by credit growth accelerating since September 25 and deposit growth not keeping pace. Consequently, CD issuances have started rising and CP issuances are holding off. RBI actively intervenes in liquidity, and they have ensured that liquidity remains sufficient. In the debt, income and income plus arbitrage fund of fund continues to remain best product for investors looking for debt exposure in their portfolio. The tax rate will become 12.5% for capital gains out of income plus arbitrage omni fund of fund post 24-month holding. Gold, we have remained bullish since March 20, bearing 2021. That call has come right. Silver, we gave call to buy in April 25, and by and large, that call is working. As we had mentioned earlier, central banks on the Eastern world will continue to buy gold to copy Western world central banks whose majority holding is in gold. Polish central bank approved a plan to buy 150 tons of gold. Normally, such announcement results into punters racing to buy ahead of Bank of Poland. In the fourth quarter 2025, we saw drop in central bank buying of gold against 2025 expectation of 1,000 tons of gold buying. Central banks bought about $825 billion of gold, 825 tons of gold. If this continues, gold prices could weaken. If they continue to buy, gold prices could get supported. China is a difficult player in terms of disclosure. Market believes the actual buying of Chinese gold is far more than it is being talked about or disclosed. Chinese gold ETF has started seeing some outflow, but as is the information from China, it's difficult to believe how much is right, how much is Narova Kunjrova. The market still believes gold demand could go up, driven by investment demand from ETF. This ETF demand could keep gold prices supported. If we see the history of gold prices, after every rise, there is a phase of consolidation before a next move is made. India has been importing silver at record pace. As the prices have gone up, so has the demand. China stopped exporting silver in December 24, in December 25, and that could have material impact on silver prices, as China is one of the largest suppliers. Silver prices, after an amazing rally since April 25, has corrected sharply. Silver's deviation from 200-day moving average looks on the extreme, requiring caution. Gold silver ratio is now slumped below 50 times. There are users who have started replacing silver because of the higher prices and supply crunch. If more and more users follow this model, then the demand for silver from industry could come down, impacting prices. Our outlook on gold and silver remains bullish based on de-dollarization trend, but it comes with certain caveat. Please put a cap as a percentage of portfolio, because both gold and silver has no intrinsic value. As an investor, be ready for volatility and invest for long term. As a trader, go with stop loss. Observe what central banks are doing in gold and silver. If they are buying, you should be a buyer. If they are sellers, you should be a seller. Like lab-grown diamond came and impacted natural diamond prices, keep a watch for lab-grown gold, silver. Be ready for volatility, as there are lots of rumors running around, and hence precious metal should be kept as a percentage of portfolio. If I have to summarize, growth will be lower, rate cuts will also come down, and geopolitical volatility will be higher. In debt, focus on post-tax carry and performing credit AIF. In gold and silver, it's a game for strong hands. You are running ahead of central bank buying of gold. There should not be any technological innovation to disrupt gold making process. Do expect higher volatility and moderate return from equity. The returns could exceed if FPI is turned buyer. The risk return trade-off is better in large caps and mid caps. Sectorally, consumer discretionary, cement, private banks, looks they will outperform broad market. Chemical, 1 year is accumulation mode. It may underperform broad market, but over 3-year basis, it looks attractive to invest. This is our asset allocation, which shows we are neutral on equity and overweight on gold and silver. This is our allocation across market cap, overweight mid cap and large cap over small cap, and sectoral consumer discretionary like automobile, consumer discretionary per se, healthcare, hospitals, financial services, and cement. Theme-wise, consumption, financial services, and healthcare looks attractive. Our focus product remains Kotak Flexi Cap Fund. I'm sure you would have seen its advertisement. Kotak Business Cycle Fund and Kotak Pioneer Fund. Kotak Multi-Asset Allocation Fund, which is a Harfan Maula fund. And Kotak Income Plus Arbitrage Fund for debt investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.